Ladies and gentlemen, are we excited for our first panel of the day? We've got some real heavyweights on the stage representing YCase. We've got Rachel Rodman. We've got Emma Laurent from JP Morgan. We've got Dr. Anika Patz from YPOG. We've got Laurent Marochini from Standard Charter. And we've got Lior Lamesh from GK8. Ladies and gentlemen, give the panel our first panel of the day of the EBC convention a big round of applause. And Rachel,
yes,
the stage is yours.
Good morning, everyone. We are so happy to be here and to kick off the conference with you today. My name is Rachel Rodman. I am a litigator and partner with White & Case, which is a global law firm. My firm has been involved in a number of crypto projects over the years, including for Meta and El Salvador, and we're currently working on a variety of stablecoin and other projects globally. We are here today to talk about the quiet giant, stablecoins in the institutional spotlight, and we have a fantastic panel for you. I'm going to start by allowing the panelists to introduce themselves, beginning with Emma.
Hi, everybody. Emma Landriault from JP Morgan. I sit in the payments business, so we focus on moving money and doing pretty much everything a retail bank would do for all of you, for large institutional clients. I sit in the Connexus team, which is a subunit in the payments business, and we're focused on everything that the bank is doing with blockchain as an underlying infrastructure. So this includes blockchain-based payment rails, as well as creating tokenization infrastructure for the introduction of tokenized securities that our clients can trade with, and most recently, bringing some of our deposit products into public blockchain. Thanks for having me.
Wonderful. Anika?
Yeah, thanks. Hi, I'm Anika Patz. I'm working for the European law firm YPOG. We're mostly based in Berlin, Hamburg, and also London. My team and I were working with banks and fintechs to get their licenses under frameworks such as MiCA, the DLT pilot regime. So our clients are like fintechs like Bullish, 21X, and I'm also chair of Bitkom, which is Germany's biggest association for the digital industry, and there we advise and do some heavy lobby work for the stablecoin industry.
Hola Barcelona, good morning to all of you. Laurent Marochini from Standard Chartered. I'm the Chief Executive Officer. I'm based in Luxembourg, where we are focusing on the digital asset custody for some cryptocurrency. We are registered by CSSF. We are in the process to get MiCA, and of course we are part of Standard Chartered group, and we are a subsidiary of the UK. And nice to see a lot of faces here.
Hi guys, my name is Simon. I'm CFO and CPO of AllUnity. We are the first German stablecoin issuer under MiCA, and previously been in different roles in the blockchain and banking space, Deutsche Börse, Commerzbank, mainly about issuing tokenized securities and a bit of payment stuff, and very much looking forward to this great discussion around here.
Hi everyone, my name is Lior Lamesh. I'm co-founder and CEO at GK8. My background is cybersecurity at the level of national security. GK8 is a Galaxy company. We've been acquired by Galaxy 2.5 years ago. Galaxy is a NASDAQ-listed company, market leaders in digital assets and AI. At GK8, since 2018, we're in the mission of increasing the level of trust in the market by providing the most secure self-custody technology, utilizing two core solutions, impenetrable wallet, which is the next generation of cold wallet by being truly offline, alongside with the MPC technology. We are working with both traditional financial institutions and large crypto-native companies, enabling them to offer services such as custody, tokenization, staking, and DeFi. We're working with companies such as DTCC in the US, our colleagues here in Prosegur, with AllUnity as well, in the Euro Stablecoin project. And yeah, very excited to be here today.
Thank you, everyone. I'd like to start by setting the table. Sorry for that. So let's talk about where we are right now. And I'd like for Laurent and Simon to weigh in. What is the current state of institutional adoption of stablecoins. And when you talk about this, I want you to be specific. Where are we? What projects are you working on? And what's your take on where the market is for stablecoin adoption by institutions?
I start, my friend? Okay. So where we are. So if you just remember the slide of Victoria just before, so in terms of market capitalization for stablecoin, we are now at 300 billion of assets, so it's not a small amount anymore. If you remember, the first bank in the world, the capitalization is at 800 billion, so the the stablecoin market is not small anymore, it's growing. And if you are going to the press each day, you will see a notification that a bank is launching a stablecoin, that you have a consortium of banks that are launching stablecoin. So we are very, now we are in the, not in the adoption phase for me, we are more in the hype phase for the moment. So a lot of things needs to be done in the stablecoin market to get the full adoption. From a regulatory perspective, with the Genius Act, with MiCA, we know where we need to go in terms of stablecoin. We see the interest from the institutional investors, from the different banks. We understand the potential of stablecoin, but yeah, we are still on the early of journey, and I have seen a report from Citibank, stablecoin in 2030 that they gave a note of 0.5 out of 10 for the maturity. I would say it's not 0.5. Let's say we are at 2 or 3. It's still we are still at the early of journey. So in terms of use cases, we see a lot of interest from still the trading and DeFi. I think it's the use case number one, and that's why you can see that 99% of stablecoin are USD denominated. In terms of use cases, we will see more atomic settlement, and I think my dear friend from AllUnity can elaborate on that because he's working on that. And also treasury management is definitely a very interesting topic. So trading and DeFi, atomic settlement, and treasury management are the main three use cases we can see today. And from my perspective, we are working in Hong Kong to set up a joint venture to have a HKD stablecoin denominated with HK Telecom and Animoca brands. So it's still in progress. We are working with the regulator. So we build these use cases for retail. And I give the mic to my dear friend.
Many thanks, Laurent. Very kind. And couldn't agree more. I think Laurent has mentioned the numbers perfectly well already. And as you can see in the market, stablecoins are right now, to be honest, by far the most feasible use case for applications of what we call in the crypto space, yeah, of kind of products that are actually being used. Still, the volume is only an insignificant fraction of what is possible if there is really institutional adoption. We talk about institutional adoption of stablecoins, but it's mainly crypto institutionals that are using it right now for settling trades. Yeah, Laurent, my friend, has mentioned it. Yeah, settling trades is right now the most feasible and almost only use case, besides some remittance of retail business in South America. So that is already driving a 300 billion value in this market. If you think about institutions in the existing TradFi economy, or also in the existing, let's say, producing economy entering the market and using stablecoins for selling machines to South America, to Africa, having an instant settlement without the counterparty risks of the different banks that are involved in this process, the time it takes, the costs it incurs, that's only a fraction yet. And now let's take a look at the European market, as my dear friend Laurent has mentioned as well. European market is also an insignificant fraction of the total stablecoin market right now. So what is the growth potential? It's very easy. look at the relation of US dollars to euro in the existing currency markets. The relation is roughly that the euro makes up 20 to 25% of the global US dollar volume. That is the long-term distribution of currencies in the existing market. What is the relation for the crypto market? You have roughly 600 million in euro stablecoins and 300 billion total.
I feel a little embarrassed as the only American up here.
Oh, good, no worries. It's not your fault, it's ours. And the thing is, however, if you look at the potential, what does this mean? It's 0.5% that could grow to 20%. Yeah?
Well, how's that going to happen specifically? I mean, I'm interested in your take, Simon, on how euro-backed stablecoins. I mean, we also want to talk about what the opportunities are for the next 5 years. It sounds like increasing in volume of euro-backed stablecoins is one of them. I mean, what's your vision or take on how to increase those adoption levels over the next 5 years?
So the crypto space is already settled in terms of trading with stablecoins, and there the euro stablecoin volume will grow a bit, yeah, but maybe not as much as we expect, because the trades are already being settled in US dollar. Some euro-based traders will rather prefer to settle in euro. This will increase, but not significant to the extent that I just mentioned, moving from 0.5 to 20%. But now let's look at corporates who actually pay wages in euro, who actually receive bills in euro, who actually make money in euro. They have no intent to use a US dollar stablecoin, but those that are already so far in terms of infrastructure and innovation that they want to do it, they still use US dollar stablecoins right now simply because of the market being there. And they clearly say, hey, I would prefer to not have the FX risk in my natural business. I would rather settle it in euro. And we have very specific, because you asked for it, very specific cases where there are large corporations, for example, that have a daughter company in Turkey. What can they do in the future? They can pay their employees in Turkey in euro instantly without any additional effort, without them having the need to have accounts. Or take internal reconciliation of large companies with, let's say, 100 daughter companies. They have a lot of intercompany payment. Right now, really expensive, really slow. You can do that for a fraction of a transaction price, like, I don't know, 20 cents a transaction because of gas fees only, instantly within one large corporate, and reduce all these internal reconciliation.
Thank you. So, Lior, I'd like to let you jump in here. We're talking about where institutional adoption of stablecoins will be in the next 5 years, and how do you think about that? How does GK8 believe it can support that growth?
Yeah, so I think we are involved in a few of the most high-profile tokenization projects currently, and there are some patterns that we recognize that we think that going to be the main things that going to make projects successful. There are three core pillars that we see. First is, in order to make a project successful, is having a trusted, traditional financial institution partner with the needed brand name in place, because eventually it's all about trust. And once you have trusted names, taking the responsibility of building such a project, such as our friends at AllUnity, which is a joint venture that including also DWS, which is formerly the treasury arm of Deutsche Bank, or of course the guy from Standard Chartered as an example, right? So that's really one of the things that can increase the level of trust. Secondly, there is a need for involved digital asset partner, someone who is already deeply rooted in the space and have the needed connection to make things happen. That's, for example, where Galaxy comes into play. At Galaxy, we're supporting such projects with distribution, with liquidity, with market making. We have the know-how as to how to do things properly from a regulation perspective. We're deeply involved in a lot of the crypto foundations, so we literally can bring in investments that can make the project successful even before it starts. And the third pillar is from the technology perspective. There is a very important need for custody and tokenization engines in order to make enterprise-grade technology that makes such projects happen. And what Galaxy and GK8 bring to the table is really bridging the gap between the traditional assets to the digital assets where such a project come into play.
Thank you. Laurent, do you want to jump in here on, you talked a little bit about what you see as the future, but any closing thoughts on where we will be in 5 years?
So where we will be in 5 years, I think I'm not the best in terms of prediction. But for me, from a regulatory perspective, a lot of things has been done, and I expect in 5 years' time that we will have a MiCA 2, MiCA 3. I don't know if we will have a Genius Act 2 or 3, but of course there will be some evolvement from a regulatory perspective. But a lot of things has been done, and we have definitely the clarity on that. I expect, of course, to have more volume, especially in the atomic settlement, because we can see a lot of opportunity in the tokenization. And if we want to grab all the opportunities, we need to have the cash on chain. So if you have an electric car and you have no electricity, it's the same with tokenization. If you have a tokenization engine and you have no cash on chain, so I strongly believe that we will have a lot of operation cash on chain for when it comes to atomic settlement, and thanks to AllUnity, but also we will probably see CBDC wholesale also, especially in Europe, moving forward in the coming years. But we can't wait to have a CBDC to move forward. So definitely treasury management also, and we were speaking just before with Simon, and I expect to have a lot of operation on that. And we will still continue to have the crypto trading, because this is where stablecoin was starting. So definitely I expect to have more volume. If you are just looking to the different studies, we expect to have between 1 and 4 trillion in stablecoin by 2030. So the market is going to grow, the volume is going to grow. We will have more use cases, but if we are just working to the full adoption of the main 3 use cases, it will be already a good milestone.
Thank you. All right, so it's not all roses and buttercups in the stablecoin institutional adoption space. There are challenges, and we want to make sure we talk about some of those challenges, including challengers or friendly coexistence between stablecoins and other DLT technologies. And I'd like to turn to Emma. So, Emma, what do you see as the stablecoin opportunity versus tokenized deposits? What differentiates deposit tokens from stablecoins? And how in particular should institutions that are considering these new technologies think about the pros and cons of tokenized deposits and stablecoins? That's a lot, but I know you'll get through it.
Of course. So I might not be the challenger that you're all expecting, because I think our view is that tokenized deposits, or as we call them, deposit tokens, blockchain native deposits, right, stablecoins and other types of DLTs will coexist. Today, we have a standard of M1 and M0 money. Central bank money and commercial bank money continue to coexist. They cooperate throughout the day. And we believe that as the space will continue to grow for certain sets of use cases, stablecoins will be adopted, and they'll become your M2 money. You'll have M1 money being commercial bank money sitting in between that, always finding finality and maintaining singleness of money into central bank money. So we do believe that these will coexist. We see stablecoins as really useful for certain use cases around things like retail cross-border flows, right? An area that is still very ripe for innovation today. I'm Canadian, I live in London. It still takes me 3 days to send money across these two countries, right? Also things like US dollar store for certain ways of getting US dollar for large institutions. So there will be those use cases, but we have continued to see an ask from our institutional clients and from the parties who will bring significant liquidity into the public blockchain space to be able to engage in the space in a way that is aligned to their existing risk profiles, risk management, and treasury operation. So we've recently introduced JPMD. It's in a proof of concept right now, where we have brought in, from a technology perspective, a deposit that is in a token format that technically looks the same as a stablecoin. So it's built on common token standards like ERC20. It can engage with the DeFi infrastructure, albeit permissioned, and created a payment instrument that allows that is really just a single fiat currency, which represents funds that have been deposited by a client and can be transferred between our clients and clients, so building that ground of transferability. And this has allowed a couple key benefits. The first is bringing in balance sheet certainty, which again is not critical depending on who you are in the chain, but for these large institutions, they need to have clear certainty around what they're holding on their balance sheet and how to do things like capital ratio, stress management, and capital policy reporting around that. So we wanted to bring in a deposit tool that would allow clients to just synthesize their holdings on the public blockchain as part of their total deposit positions so that their treasuries know how to treat it. And we see this as important for bringing high big ticket and high liquidity trades into the space. And also to have things that traditional deposits could bring from a risk profile perspective, like being able to manage that liquidity according to existing treasury operations, being able to bear yield, being able to have deposit insurance. So we are really looking at how to bring something that can allow institutional clients to continue BAU as a form of cash into this space. And we think it's quite compelling from a risk perspective, right? Because if you're looking at stablecoins from a treasurer's perspective, what are they really doing? They're taking on and holding on to, issuer risk of a ton of high quality liquid assets that sit at different reserve banks. So managing that risk profile and ensuring that the net asset value of all of those reserve assets are always equal to or more than a deposit token than the stablecoins in circulation is a significantly more complex operation. So we're really looking to hopefully bring that efficiency for new players. And I think for use cases, be able to do a lot of the things that Simon and Laurent and Lior mentioned, right? Be able to use this as a form of blockchain native cash for settlement of digital assets, be able to make peer-to-peer payments cross-border at any time, and to even have a format that can work in things like automated market making, liquidity swaps, right? A type of just US dollar so that we can bring in those traditional players. And Simon mentioned quite a bit around some of the different institutions actually being able to come in. And I think what we're hoping to do is to say there are a number of institutions who want to invest in things like institutional grade RWAs, right? But there's not enough liquidity. So how can we bring in market makers who would market make those markets but won't hold significant stablecoin holdings into this ecosystem to actually bring that liquidity? Right? How can we allow the corporates who may not be, or corporates or asset managers who, again, may not have the comfort from a compliance perspective to hold significant stablecoin, how can we bring them into the market? And that's what we're really trying to do with bringing in a form of just US dollar. So we don't think it's one or another. We think it's going to bring different players into the ecosystem at different points with different grades of liquidity. And ultimately, what will be key is how stablecoins start to clear, how central bank money and commercial bank money in this new public blockchain environment start to coexist, and we can create a system without increasing kind of the systemic risk or having the risk of, frankly, too many stablecoins, right? Because I don't think we want to be in a world where you have to walk into Starbucks.
Everybody has a stablecoin.
Correct, right? And you're like walking into Starbucks and thinking, okay, what coin do I have to pay with? Right? So
True.
I think that's going to be the key as we continue. So it's going to be different use cases, different players, and different assets that appeal to those players based on their operational risks profiles.
All right, Simone, I have to let you get in here. Do you have any thoughts on what Emma said?
Yeah, at first I think there are good cases for a deposit token, and that's totally valid. And I think also the question, how do we bring liquidity in the market and how do we prevent what has happened in the banking space already, because it's heavily overbanked. So that shouldn't be the case as well for the stablecoins. We shouldn't repeat that mistake. I'm totally with you. And looking at how can stablecoins be brought into the market with liquidity, I think one exciting part especially is also education. And here the movement of the banks is actually pretty good for us. It has been mentioned that now many banks go into this topic. When we wanted to get a bank account 1.5 years ago, the banks were still like, and I've worked for several banks before myself, the banks were still like, okay, you're a stable coin, so you do crypto, what does this mean? I'm not sure if we can give you a bank account. This has for sure now changed, which is very good. Part of the education as well is, how is a deposit leveraged and backed? By, let's say, 12% roughly on average core capital. Yeah, so CET1 capital, that's a regular ratio that you would have for a European bank. How is a stablecoin backed? 102%. And so in terms of like counterparty risk, I think it will be part of the education to see that actually due to the stablecoin issuers not being able to do leverage and thereby including yield, this will lead to even, it's basically an over-collateralization with cash right now, what we have. And I can literally tell you, we have to hold cash 100% of the assets that we sell to the market, so to say, and where we receive the money on accounts. We'll have to put it on segregated accounts, so it's not even on our balance sheet, so to say. Yeah? And additionally, we have to have 2% of own funds as regulatory capital. So because I have the discussion with many former banking colleagues, I said like, how is it backed? Yeah, is it the same level? And say, no, not at all. Yeah, the money on the account is backed by 12% high quality liquid assets. Our money is backed by 102% high quality liquid assets. Yeah, so I think that's good, but there are very different reasons to use the different assets for different use cases for sure. Yeah.
All right, well now we're going to take a little bit of a turn and talk about
You won't
everyone.
let me respond?
Oh, go ahead. Oh no, oh my gosh. No, we love vibrant debate on our panel as kicking things off. No, do you want to go ahead? Go ahead.
I guess the question is why, right? Why does it have to be backed at 102%? I mean, we've seen so many crises in the stablecoin space. So there's a risk profile with holding these reserve assets around these underlying institutions that has to be managed, right? And I think there are questions, don't get me wrong, right? Every like 10 years or so, there is some group of banks that something goes wrong. So there's risk management that has to happen in both. But I think the point is we've seen so much value be wiped away from the stablecoin market, and that's ultimately what's driving 102 risk weight, right?
I also just wanted to add quickly from the technology providing perspective. It's clearly more your part, but since when you do deposit tokens, you remain in the internal banking balance sheet, it's easier that you don't need to take on new regulations and new licenses, I would say. So in the project that we are involved, it makes more natural for banks to start tokenization with deposit tokens because it's easier for them and it's sufficient just to partner with technology providers like GK8 on tokenization and custody, so they can do the whole issuance, minting, burning, and everything internally without additional, I would say, external challenges and parties that should be involved. And I think also, I might jump over, but also the ability to have interest on deposit tokens, right, other than stablecoins, which cause some issues according to Mika and the Genius Act as well. So I think that's also a reason why to start with that.
We are now going to talk a little bit about regulation. And I want to turn it over to Anika. So I'm a US lawyer, and I don't know very much about European regulation, but I do know that in the US, with respect to the crypto space, we've had a different approach, which has been not a lot of regulation, other than regulation by enforcement by some of our capital markets regulators, but not sort of a clear statutory framework. And that has, created the dynamics, industry dynamics that you see in the United States. Whereas in Europe, I think there was a different approach. And so I want to understand from Anika how MiCA shaped adoption of stablecoins in the EU. Was it ultimately helpful to have that regulatory clarity, or do you think it was maybe not so helpful? And how do you think regulation fits in for the future of adoption?
Great question. So I think MiCA significantly reshaped the space for stablecoins in the EU. I mean, imagine you would wanted to issue a stablecoin, you would need to get like memos from law firms all over the EU 27 member states. You might wanted to issue a stablecoin, and each of them had a different regime. So I think this was quite burdensome for the businesses. And as we see today, we have like big banks, incumbents that are taking on stablecoins, like this consortium. This was mentioned already. I think this wouldn't have been possible without MiCA in place. So for us, I would say we were the first jurisdiction, like a major jurisdiction that took on a regime, a harmonized regime that made it now maybe easier to tackle the European market and to be able to serve cross-border. But on the other hand, I would also say, as MiCA is quite a strict regime, which doesn't give you much room to explore different business models of how to set up a stablecoin, we also saw that some of the businesses vanished. Like Tether, we haven't heard of them anymore in the EU. And also, it's quite burdensome to set up your business. You have compliance costs, you need to apply for licenses. So I guess it's a huge advantage then for banks and regulated businesses to go into the space. But if you are a smaller player that has just a stablecoin business, I guess it's quite, maybe Simon can tell us more, not too easy to find a business case, as you have this like reserve assets, a huge backing, and you're not allowed to pay yield to your holders. And also the exchanges in Europe are not allowed to pay out holders any interest on stablecoins they have. So I guess this makes it quite strict, a quite strict regime for European players to actually find their business cases and to be able to like, put their feet on the ground here.
Thank you. All right, I want to turn to a different topic, which we've been touching on a little bit, but I want to open it up to the panel to speak about it more specifically, and that is token governance. So when we speak about token governance, what we're really talking about here is trust. And Laurent, I'd like to start with you. From your vantage point at Standard Chartered, what does institutional grade token governance look like?
Good question. So I think that behind the trust, the non-negotiation is security. So we need to bring a maximum of security in your coin framework. This is definitely a key element. After, interoperability is also a very, very important feature because it will bring the full adoption of the stablecoin. And you touch the point about governance, which allow to bring transparency and accountability. Also, a key element is for us, so a stablecoin, we are a regulated bank. So if we issue a stablecoin, like you have issued, no choice, we will go to the regulation, whatever it's MiCA or in US or in Hong Kong. So when you issue a stablecoin under the regulation, at least in terms of framework, you are quite limited because the risk framework is already brought by the regulator in terms of reserve assets for the transparency, the different audits, the smart contract and so on. It relies on the issuer, but the risk framework is up to the regulator. So we will have to define the risk appetite, the risk framework, and we will do it in line with the regulator. So I have to say that it's not a challenge. So we will definitely move forward in this direction. And by the way, security is a key element for the trust. And governance, I have to say, it's part of the security, finally, at the end.
Well, speaking of security, thank you, Laurent. That's a great segue to Simone and Lior. You all have been working on these projects, and I'd like to talk about how you embed governance at the protocol level. If you could talk a little bit about what you've done together at AllUnity, that would be great.
Sure. So I think before we get into tokenization, at the beginning where we were doing governance layers, it was mainly policy engine that should enforce more basic things, right? What users can do what on assets movement perspective. But when it comes to tokenization, things are become different and become more challenging. As technology provider, for us, it's not longer just to provide custody technology, but also the tokenization issuance. So at GK8, we provide tokenization wizard that enabling our clients to create a smart contract within a few clicks, and it requires also policy as to who can do it and what are the limits about doing that. Then there is the layer of making what we call the superpowers, right? The admin key that should be in charge of making minting and burning and updating the allow list, or who can freeze assets and unfreeze assets, and only then the custody layer. So instead of just making policy on transactions, we now need to do policy on the smart contract level. So for example, we need to support the teams to decide which users can do minting and how much minting any user can do per certain time, and so on. So it's really different. We are not a regulated entity that need to hold assets of clients, but our clients do, right? They need to follow MiCA, DORA, BaFin requirements. So we need to ensure that everything from AML capabilities and segregation of assets between the institution to its clients and the policy engine could be supported with our technology.
Yeah, we've been working, I think, very closely together with the team. Also now seeing some faces here. First time in Barcelona, actually, like face-to-face, which is also kind of nice, working together for more than a year on the operations side. And I think what is really important, as Lior has mentioned, is the actual management layer around the solution. I mean, having a very solid key management, including key ceremony and so on and so on, that's standard in crypto custody right now. I've been following the space also very closely for years, and having the key ceremony and the basic stuff, that's like, you need to have it. That's no question at all. But what differentiates the players, especially in then setting up business on top, is the management layer. Yeah, in how far can I have processes where I define user groups, where I know pretty sure that only specific user groups are allowed to trigger transactions, in what order, with what signatures, from whom, according to which policy and stuff like that. Because also that is the, coming from the security side, I would say more critical part actually. Yeah, if you look at classical banking as well, what is not happening is that, let's say, the core database of the core banking system is not working properly, but instead you have issues around the management layer where there's a policy not correctly defined, or where somebody that shouldn't have access still has access. Or like if you have a leaver, for example, or a new joiner, how's the onboarding process? How do you provide these new users? How do you do changes to user groups? So that's much more important, and here really a solution differentiates. And I think here we perfectly work together very well, and happy here also to have trusted parties, which is very important, that have also gained and developed along the way, also for the years now, also seeing that development in the market. And also here there's this like congestion of players with Galaxy that have acquired GK8, then both of you together with the knowledge and also the reputation of Galaxy, basically, that really helps to set up a business that is then also trusted by our clients. Because also our clients rely on that, despite the regulation, of course. Every part of this chain is a significant outsourcing according to regulation, especially to DORA. So you have to have a high level right now. If not, you cannot enter the market anymore. But that has surely developed in the last 5 years, I would say. Yeah.
All right, Emma, I know you've been doing work on this space, in particular Connexus with MIT. Can you talk a little bit about that?
Definitely. And I mean, I echo everything that the team has said over here. I think that that's table stakes, right? Is having good governance, off-chain, on-chain integration patterns, policy and management of that, key management systems, right? None of that goes away. But I do think that we now, as we're starting to see regulated institutions or previously unregulated institutions now coming into the regulated space with some of the new stablecoin legislation, a new dynamic is also emerging, right? Which is that at a protocol level, you're not embedding necessarily permissioned or privacy, because these protocols are public open source protocols which exist today. So there's some new dynamics around how are we actually implementing governance and permissioning at token level, right? Your token now becomes your new boundary that you want to control. And so we did some work earlier this year with the MIT DCI team to map out token standards for regulated payment token issuers. So this could be FIs, NBFIs, central banks, any party who's really working in a regulated environment. And what we tried to do was, one, showcase that we should be taking an approach in this world to composable standards. So not necessarily rebuilding these long, large standards that have taken 20 plus years to develop, like ISO, where, by the way, there's still tons of banks who would want to see different things in those standards, right? But to actually say, well, based on the requirements that we as these regulated issuers would have, what existing EIPs from an Ethereum perspective can match to that, right? ERC20 works really, really well for transfers. ERC 4337 works really, really well for gasless transactions. So we wanted to take that approach and then see what's missing. And we acknowledge two gaps. The first is in admin controls, which I'm sure the crypto people will roll their eyes at a little bit. But when these are regulated institutional assets, we have the requirement to be able to seize funds, to be able to restrict access. If, for example, a sanctioned entity gets access to your token, right, or a sanctioned wallet. So we wanted to look at how can we create admin controls, and then the second being wallet to bank or wallet to root trust API integration to actually issue attestations. Attestations for things like identity, for things like the ability to transact up to a certain amount, in order to really get to a place where we move away from kind of traditional correspondent banking of inline payment controls to having these controls which are executable at any point that your token is in circulation, whether they're held by your client or a client that's been KYC'd by another institution, an exchange, or another party, right? And I think it matters broadly for kind of two reasons, and we took this on for two reasons. The first is that with institutions going into public blockchain, speed is critical, and the ability to apply controls is critical, because now your vector of risk, everything moves faster, right? Malicious transactions can be executed instantly. So if we're not building in the right cybersecurity controls and the right controls on the token layer to be able to stop or pull back transactions, your risk is significantly higher, right? The second is that we also need to maintain, and we've actually published an open source GitHub. I can share it with anybody who's interested. We're working with the industry on the development of what these standards should actually look like. We really propose this just as a starting point, but we want to work with the industry because we want to get to a place where there are certain standards used across regulated tokens, right, whether they're the existing ones or these new ones, to maintain interoperability and to ensure technical fungibility. Because I think a place that we don't want to get to is that you have all of these institutions, one, issuing based on their own standards, and two, none of it is interoperable with DeFi infrastructure, right? You should be able to put this regulated token in a custodial smart contract. You should be able to use whichever wallet provider of choice. So I think we really see this as a starting point for the industry, but it's something that we want to work on to maintain that fungibility and interoperability cornerstones to ensure the safety and soundness.
And increase adoption, which is what we're talking about today. All right, we have a few minutes left, and I want to focus on a quick lightning round on a very weighty topic, which is the US Genius Act. As our hosts mentioned at the beginning of the presentation, the United States finally, our Congress finally passed the first federal legislation regulating DLTs. And it's important for that reason, because it takes a long time for the Congress of the United States to do things. So it's significant that they were able to pass legislation in this space, but it's also notable that that legislation is only covering one particular technology, and that is stablecoins. So I want to turn it over to Anika. We now have the Genius Act. It has passed. It is law. It's not effective yet, but many companies throughout the globe are thinking about how they can utilize the Genius Act for their business. And Anika, I wanted to get your take from a European issuers' perspectives. How are they thinking about Genius? What are you hearing from your clients?
Yeah, I mean, when I talk to clients, they're mainly asking, how can I enter the US market now? Because there's this kind of opening saying that also similar businesses, foreign businesses, might issue stablecoins in the US. And I think we're now exploring how is this possible. So I guess it's not really 100% certain yet how we will achieve equivalence. I guess in the end it will be highly a political topic, saying if you are equivalent to issue a stablecoin in the US, I also want to issue my US dollar stablecoins in the EU and get the same like market entry without setting up a business. But when we talk to clients, then we're kind of thinking about what would be the right way to go. Should you set up a business in the US? I guess from the perspective of liability, it makes sense not to go with your European entity and enter the US markets, because you never know who's going to...
You never know who's going to sue you in the United States. It's true.
Then they should call you, I guess. No, I guess there are so many open questions still remain how to enter the US market, but I think it's worth exploring. Questions are, can I use the reserve assets I already have for my stable coins I issued in the EU? Do I need to ring fence the business? And also compliance costs, do I need to really fully apply the US law? And do I need to have then two sets of compliance, being under MiCA, being under the Genius Act? And how can I handle it internally? Do I need to have people on the ground then in the US to actually manage my business there? I think there are many open questions still in the room, but I guess it's worth exploring, because we saw in the last months when Genius was announced, I think it also gave a real boost to the European industry. So yeah, excited to see how it's going to end up.
All right, Simon and Laurent, quickly, what does Genius mean for MiCA compliant, meaning, well, let's talk about EU-backed stablecoins, Euro-backed stablecoins, good or bad?
Okay, I can start. So I think what is kind of interesting, we had actually like months ago 2 congressmen in Germany and had some background talks, and one of them is actually the chair of the Financial Commission. So he was actually the one that I would say formed Genius a bit, and we had a really, really good exchange. I mean, they were extremely knowledgeable. To be honest, we had also exchanges with politicians from the EU, but they were much more knowledgeable. Yeah, and what was really interesting is that we had a common ground, especially on one topic, and that's the multi-issuer topic. Yeah, and you mentioned it quickly with the reserves. Yeah, right now you have issuers in the market that mix US and EU reserves. And that's really a structural issue. If you want to look for some fuck-ups, you mentioned it, Emma, there is potential for fuck-ups in stablecoins. Yeah, I'm pretty sure the multi-issuer is one, yeah, because you mix up the reserves, so they are not protected. It's very easy. If it's mixed up, you cannot protect them locally or geographically. And the fun fact is, neither EU nor US regulators want that, actually. The US ones want to save the US reserves. The EU ones want to serve the EU reserves. So there we had a very much common ground, and so I would expect that this will pretty soon change, yeah, from both sides, that the reserves will be protected per regulation.
All right. Laurent, what do you say?
Very quickly, in US they innovate, in Europe we regulate. What is clear is, as we said, 90% are US denominated in terms of stablecoin. There will be no CBDC in US. And in Europe, it's still question mark, not question mark. We are supposed to get a CBDC wholesale and retail. But for me, the final answer will be the industry, like AllUnity, what you have done, and the different consortium in place. So we see more adoption, and I think it is the answer will come from the industry itself, and it will come in Europe, but always with. We need to be checked sometimes in Europe. So it's happening now in US, so it will come in Europe, but later on.
All right, Emma, as I mentioned, Genius Act is about one kind of product, and that is stablecoin. So I'm wondering how you think about it from the perspective of the tokenized deposits you're working on.
Yeah, so I mean, tokenized deposits in the US are not subject to Genius, but I think like Genius is certainly significant, right? And we've seen the market players react, whether it's stablecoin summer. I feel like every week I open like LinkedIn or X and there's a new stablecoin announcement.
Hashtag stablecoin summer,
yeah,
I love that.
Right, there you go. So and the market players are reacting. We're also seeing so many new like layer ones, right, being announced, a lot of new infrastructure players. So I think it's driving more attention to the market. A few things that I'm personally, right, just my personal view, kind of looking at from Genius. So I think one thing that we're tracking will be, and most of this will be found out as we get market structure frameworks and market structure legislation, which should be around next year. the devil is always in the
We'll
details.
see.
But I think one thing is, which Anika mentioned, like what will this look like bringing a MiCA compliant stablecoin into the US, right? Will there be parity across the regulation? Will there be European stablecoin issuers who need to do a ton of analysis to understand whether or not they're Genius compliant? So I think that's one big thing that, just based on this room being European Blockchain Convention, that I'm personally keen to see how that plays out, and one of the watch items from my side. And then I think the other one is really like what equivalents, if any, will be created for things like transaction monitoring requirements, for things like monitoring for AML, for KYC, and I mean broadly sanctions I presume will apply regardless of who the issuer is. But I think right now in the US, right, and again, just my personal view, but as we look at the regulatory landscape, if you're a bank issuer, you're subject to things like the Bank Secrecy Act, which require a ton of AML, transaction monitoring, and really, like at the core, making sure that money stays out of the hands of bad people, right? And so I think it will be interesting to see as we get to the market structure regulation, what will be, if not exactly the same from BSA, what will be pulled into the Genius Act, and then how stablecoins will start to implement that, because I think it gets to, again, a lot of the heart of the work that we did with our friends at MIT around how are we actually thinking through the same kind of regulatory requirements, but in this new ecosystem, right? And how are we programming in that governance to actually meet them? And I think that we're going to see a ton of innovation from the stablecoin and the DeFi space as we start to get this market structure regulation on how these types of controls can work on chain. So those are some of the things that I'm watching around Genius Act.
All right, everyone. Well, thank you so much to our panelists, and thank you to the audience for listening to us. And I think that's it from our side. Thank you.
Beautiful, beautiful, beautiful.